What is up? What is up? What is up? How are you, Josh Weidman?
I'm doing great, man. It's another beautiful day. Sun's shining. Weather's getting a little bit cooler.
Weather is getting a little bit cooler. That actually feels kind of nice, doesn't it?
Yeah, you know what though? I was thinking the other day, this is going to be the first. This is the first fall in my life when there's no football.
Yeah. Well, I mean, I think that's true for everybody. So
Right? Exactly.
yeah, that's not just. Are you a football guy? You watch a lot of football?
I like having it on in the background. I used
Okay.
to watch it a lot, but like
Mhm.
it's kind of like baseball. I don't have the patience for the long game, so like put it on the background while you're doing stuff on Saturday or Sunday. It's kind of nice.
Yep. Now, I do not do any of the sports balls. So,
No,
no.
nothing.
I like Formula One racing. I think Formula One racing is awesome. I think NASCAR is just rednecks turning left. But
Wow. Wow.
so, Formula One is great because they do this thing called turn right and turn left. It's kind of neat.
I can't
So,
believe you just said that. It's the biggest and highest paying sport in the entire world. NASCAR.
mm, mm, I think soccer and Formula One are both bigger on the world stage than what NASCAR is.
I'm going to Google that later on
Right,
today.
right.
Anyway,
Fabulous.
all right. So today, what do we got going? First of all, welcome to the Build and Grow with Real Estate Show. Thanks for being here. We're jumping into content this week. We're talking about stages of the housing market and actually stages of the housing cycle
Right.
and how today we're going to talk about how our current market fits into those different stages and then how to predict what comes next.
Right.
Right?
So yesterday we talked about the 6 stages of a market cycle. We talked
Yep.
about how what drives market cycles
Yep.
is basically what builders do. So at the peak of a market, we see that builders have overbuilt because they can sell and sell and sell, so they keep on buying land and keep on building. And then what happens is more inventory is out there than what the market can absorb.
Yep.
And when that happens, then I mean, it's just a simple supply and demand type situation. So values go down, the market goes into correction, then the market goes into free fall, and then we hit bottom. And during that bottomed out period, builders have stopped building. So builders stop building as soon as there's a correction and free fall going on. Builders stop building. By and large, there'll still be some building activity happening, but during the bottom, and then what the exact opposite happens. They underbuild for too long, just like they overbuilt for too long, and that causes the peak. They underbuild for too long, and that's what causes the pickup. So
I've got a bone of contention here with you. I don't know that that's I know that that is a contributing factor, and it's even an indicator of where the housing market lies. But
you don't think that's the driver?
I think it's more credit driven. I mean, I think that what you get is that at the bottom of the market, banks see the risk is very low, and so that they start lessening the credit criteria,
Right.
and we get to a saturation point where all qualified borrowers have money and banks still need to lend money to make money, and so the
They
pool of
overlend.
borrowers
Yep.
is diluted. And I mean, but the fact is, regardless of what the cause is, the housing market follows the same cycle over and over and over and over again. And the bigger the boom, the bigger the bust. And it just continues to happen over and over and over. If you look back in historical data, a lot of people say you invest in real estate and like it constantly goes up and all this and that. But the truth is, it's a much smaller market. And just like stocks, if you buy at the height and sell at the bottom, you're going to lose money. But if you buy at the bottom and sell at the top, or your strategy makes sense, and you're able to track, hey, I'm going to use this strategy in this stage, and then when the stage changes, now I'll change to this strategy. You can predict what's going to happen next, and by evaluating the data, move on and and make the right moves. Right?
100% correct.
Yeah,
Yes.
exactly. All right.
So I think that the credit cycles is very similar to the building cycles,
Yeah.
and I think that they are. We said the same thing about loans as you said the same thing about loans as I did about about housing, and I think that they both happen at similar times.
Right.
Sometimes they do not sync up, but very frequently those two are going to sync up, and the one is going to cause the other.
Right. And they feed off each other. That
Right.
right? Like it's a chicken of the egg argument. All right. So let's jump into data. So today we're going to talk about, using a crystal ball here for, the next stage of the real estate market and what that's going to look like, what you should be, where you should be looking to invest, how you should be looking to invest to capitalize on what's coming next. And in today's market, what you need to do to prepare for the coming shift of and change of phase, right?
Right. So we're going to talk about where we are right now, which we believe that we are in a late stable market.
Yep.
So we have not found the peak yet. We do not believe, and we are certainly not coming down the other side.
Yep.
So we are, basically the market is continually making new peaks and building new peaks. The problem with, the market at the bottom and the problem with the market at late stable, these two in the market cycle are the trickiest because it is difficult to say when they are going to end. It is difficult to say whether this is going to go on for another 3 months or whether this is going to go on for another 2 years. Listen, we could be in this market that we are in right now for another 2 years. I firmly believe that with everything in my heart. And it could be over in 2 years or two months. I firmly believe that as well. I believe more in the 2 years than I do in the 2 months for some reasons that we're going to get into. So some characteristics of this type of market that we're in right now is prices are exceeding any reasonable valuation. I use the term irrational exuberance.
Yep.
I was talking to somebody just the other day. They had a listing for like 340 and they accepted an offer of 380 on it. So, it's crazy what we're seeing right now. We talked earlier in the week about how there's a problem with values outstripping comps and outstripping appraisers' ability to get them. I was supposed to have settlement today on a property, and we're having an appraisal issue. It has nothing to do with the appraiser or the lender or anybody's belief that the value is there, but it is a challenge to get it. Occupancies are near 100% with zero vacancies. I can tell you right now, even during COVID, I was filling vacancies very quickly on all my vacant units. And a lot of people are probably experiencing that. By the way, this is one of the reasons you've got to be very leery during a late stable market, because a lot of C and D properties are going to perform like B properties. You're going to know that they're not an A, but there is a lot of newbies, and these people, by the way, become ripe people to buy properties from during the next 2 cycles. Their D quality properties are performing like B quality properties, and so therefore they're paying too much for them, or they're not selling them when they should, or they're not banking enough of the money. You're getting this high cash flow. You know what I mean? It's performing at that 2% rule. So you've got a $500 mortgage payment on a 2 or a 3 unit building, and you're getting $1,500 in rent. You need to be socking as much of that $1,000 a month away as possible, because during the next downturn, you might have 2 or 3 months a year in vacancy on that property.
Well, and Judah, on that note, part of this market cycle is that once we have all the qualified borrowers gone, right? All of them have bought the houses they want, all that need is satisfied, and they expand into, a little bit more risky markets. The first-time homebuyer market expands significantly, and those, if this stage of the economy lasts long enough, a lot of those C and D class neighborhoods, they'll mature into B class neighborhoods because you get enough homeowners that move in there, and it changes the marketplace. But it's always a question of buying in those first class, those first time homebuyer neighborhoods at the end of the cycle, because an area that, at the bottom is worth $40,000 and at the top is worth 135. Well, if you have 75% of that market that sold for 135,000, that's a pretty stable market.
Right.
But if you have 10% or 20%, and now all of a sudden credit shrinks and disappears or gets a lot more tight, now all of a sudden we're in a totally different ball game. Now that house is worth 40 grand, and that's a little scary situation.
Yeah, I got pinched in that the last time around. I had some good cash flowing properties that my equity just totally disappeared. And
Yeah.
I thought that the market was turning.
Yeah.
And it's hard to tell whether a market is permanently turning or whether it is just temporarily turning. And one of the things that I look for now is architectural detail. If it is a pretty simply constructed area and a pretty simply constructed neighborhood,
Yeah.
and it's performing pretty nicely, I firmly believe that is going to go back it's going to go back from a performing like a B to a C or a D quality neighborhood once the market turns.
So you're saying you like the architectural, the cool architectural detail where an area might have been a higher end home when it was built, and then
Right.
the area regressed and now it's coming back. You're saying that area probably, or it at least has the potential to stay a lot more stable. But
Right.
the standard worker class housing that was built, 75 years ago, it may regress back to that again.
Right. So a lot of these properties, a lot of this happens in a city, right? And so in the city, there'll be the factory or the mill or the, whatever there is. And then you can see the neighborhoods around it, like 60 to 70% of the neighborhoods around it are worker class neighborhoods, but there's that 15 to 20% that were managers and executives. And you can tell they're a little bit higher quality thing. And then there's those couple houses that, you're like, oh, that's where the CEO lived, or the boss, or the owner, or whatever. And so what happens is those nicer neighborhoods, once the mill closes, everything gets depressed, and then other jobs come into the town, and those nicer houses get gentrified and get raised up. And then that's also happens in some of the worker class neighborhoods around that town, around that factory. They're just straight brick housing, and what was built as blue collar workers. It should always be blue collar workers, but sometimes people go in on the inside and they make it a little bit nicer. They do higher end features and fixtures on it, and so it starts to perform a little bit better. But if inside the house, the bones of the house is a worker class house, it's probably going to revert back to a worker class house during an economic downturn. And that's okay as long as you know that.
Well, and what's a really interesting note, I've actually studied this phenomenon. The areas that are on the edge of development right now, right? They're like the outliers. If you get stuck in one of these houses, be patient.
Right.
Because remember, this is a cycle. It goes down and it goes back up. It goes down and it goes back up. If you can keep the thing cash flowing, and as long as you're not shelling out thousands of dollars every year on maintenance or whatever else, these things come back. I missed in 2008. I can remember going on appointments in this specific neighborhood in Philadelphia. And I remember walking into this house, and it was a young girl in her early 20s. She had just bought this house for $135,000. And like 2 weeks later, the bottom fell out of the market. And she's like, look, it's not safe here. I just want to get rid of the house. I'll sign the deed over to you. You just pay my mortgage. And the house was completely renovated. It was a gut reno, brand new everything. And I'm going, I'm not falling for this trick. Guess what that thing sold for in 2015? In 2015, it sold for $400,000. And by now, it's probably worth $500,000-$600,000. And that's an anomaly. But if you figure that 135 in 2008 is 235 today, like, that's still not bad, especially if somebody's handing you the deed and all you have to do is pay for the transfer. Like, that's a pretty good situation. So, keep that in the back of your mind. All right. So one of the other factors here, new investors flooding into the market. Now, if you're watching this show and you're a new investor, what this should mean to you is not that you just stop studying and just get out of real estate. This is, oh man, I missed the cycle, whatever. It means pay attention to what we're going to say at the end of the show, because that we're going to be talking about what you need to do to make money now and start your empire right now. It's not a bad time to start. It's just a different time in the cycle.
Yeah, I was shocked. 130,000 to 450. Yes, Steve. Yeah, exactly. Steve called me out correctly. I was that was literally a speechless, jaw-dropping moment.
Well, I mean, that's one of those things where you kick yourself in the butt. And it's like, oh, right. But the thing is, you don't know what's going to happen until it happens. It is just as likely that house could be worth $40,000 now. So it is what it is. All right. So let's jump in here. I want to prove my point here that this is the place we're at in the market. Okay. I think it's generally agreed upon that 2010 was pretty much the bottom of the market. Took about 2 years to flush things out. Coming around in 2010, I'm using Lebanon County because all the other central PA counties had too much volume in 2015 and recently for me to be able to pull the data and give you numbers. So this is Lebanon County, Pennsylvania. Okay. It is a good representation of the numbers that I saw in all of central PA. So 2010, 1,171 units sold. Median sales price, 153,000. Average days on market, 80, right? Almost 3 months between the time you list and the time it goes under contract. And they're selling, the sold to list ratio was 94.7%. So essentially a 5% discount on everything that's listed.
Right. And the thing that betrays, and the thing that doesn't actually even demonstrate is when you factor in that there was probably another 3 to 6% of sellers' assistance baked into that. Right. And there were probably also people listing 5 to 7 to 10% less than what they wanted to, just so that they could sell. The sold to hoped for is probably a lot closer to 85%.
Well, and how about this? This doesn't include any of the cash sales. These are just closed properties. It doesn't include the houses that were listed and never sold, or that were sold on the private market with no agent. Okay. Right. So now we're in 2015. Fast forward, we got 607 additional sales during the same 365 days. The median sales price didn't go up much, 154.9, but the days on market dropped significantly. We're talking about an entire month chopped off the sales process, and then sold to list 94%. Again, doesn't include seller's assist, doesn't include the off market.
I bet, and again, I bet that there is less seller's assist in 2015. I'm sure that a lot in 2010 there was it was between the average seller's assist was between 3 and 6% in most of those transactions. I'm sure in 2015 it was between none and 3% seller's assistance. And today, don't even bother writing seller's assistance into the offer. You know what I mean? It's just not an option.
And unless you're often $100,000 over asking and you're asking for $20,000 seller's assist or something, it's not going to happen. So the last 365 days, 1,583 sales. Now, the first thing that I wanted to look here, and it kind of surprised me, is that we had 220-ish, 225 less units sold by volume. But the more you think about it, how many houses are on the market?
Right.
Not many. We're reaching a point where whatever's listed gets sold.
In Lancaster County, there's like 400 houses on the market for 1,500 realtors. How many people live in Lancaster County? Is it like
a lot?
600, 700,000? So I mean, like there's a lot of people that live in Lancaster County, and there's only 400 houses on the market.
Well, let's put this in perspective. In 2010, the volume in Lancaster County was 4,086 units. So roughly 4 times this size. Okay. Right. So now we've got just under 1,600 units. Median sales price up 20.8% to 184.9. 14 days on market average. That's including the one that, that's $200,000 overpriced that sat on the market for 300 or 400 days,
Right. That's including the bank, homes that are absolute, crap boxes, and the bank wants 40 for it, but most investors wouldn't pay more than 10 for it, and it sits there for 60 days, just churning before the bank finally realizes, oh, I should drop the price here.
Well, and not just that. It also includes the REO where the bank doesn't respond to an offer for 21 days.
Right.
You know what I mean? So, all right. So, and 100% list to sale ratio. That is astounding. Okay. So, sales activity at all-time highs, right? The median sales price at unheard of numbers. Just I'm checking the boxes from our last slide, right? So, let's look at rentals. Here again, we've got 2010 versus 2020, 2015, 2020. Vacancy rate in 2010, 10.3%. That means 10% of your gross revenue is thrown out the window. That's just over a month, about a month and I don't know, 40 days, something like that.
Yep.
Median home price across the country, or I'm sorry, median rent rate across the country, 927. In PA, 827. Same thing in Lebanon County, 827. Great. 2015, hey, we dropped 3%. Now we're at 7.3%, approximately equal to 1 month's rent. $987, slight uptick in the median rental rate. Now we come to PA, same deal, slight uptick, and a very, very minimal incline in Lebanon County. By the time we get to 2020, though, we're at less than a month vacancy rate. And like, again, this is average across the board for the crappy rental and the high-end rental and everything in between. We've got an increase of about 22% in Lebanon County. More so, probably, 50%, almost 50% in the nation as a whole, and about the same in PA, with a small uptick in Lebanon County, right? But still, 20% increase in rental rates, huge decline in vacancy rates. So we're getting almost no vacancy rate. We got that.
Yeah. So 5%. I like to think of a 5% vacancy rate, almost as like a no vacancy rate. I remember taking econ classes and learning that a 5% unemployment rate was considered theoretical perfect. Like 5% was full employment. Now,
Right.
Other than the past, 2 quarters, we've had below 5% unemployment in the U.S. for so long it's not even funny.
Right. 12 years.
Spiked during Obama's time and then came back down, but like the end of George Bush's time and for a whole bunch of Obama and a whole bunch of Trump, we've had under 5% unemployment. Which, if you look back over 100 years, like economists just can't believe how full the economy is right now. So that being said, this vacancy rate is very similar. You're
Right.
always going to have 3 to 5% vacancy rate, and it's because you're going to have people moving for good or bad reasons.
Well, and look, people's lives change. If you have 100 units and your average vacancy rate is 5%, that's pretty darn good.
Right.
You get people, they stay for a couple years, they move out. Hey, you got to update the apartment. It takes you a month to clean it up, a couple days to rent it. Having some time vacant is not, it is not necessarily a bad thing on the surface. You'd like it to be 100%, but it's unrealistic, right?
Right.
All right. So that puts, some of the other factors, really great finance terms, like ridiculously great. We're the number 2 lender in the country, just announced 2% rates. We've got we've got gurus popping up all over the place, right?
Yep.
That's the kind of stuff that we're seeing. So Chris Gaines asked, do you think Lebanon is similar to Lancaster and York counties? Yeah. The numbers in Lancaster and Lebanon and Lancaster, Lebanon, Dauphin, and York, They follow the same model.
Yeah, they're all following the same model. I mean, they're all following the same model. Let me just give you a quick 30 seconds here, and I'm watching the clock. Lancaster, York, and Harrisburg are more similar than they are dissimilar. Okay, so those three markets are very similar. Lebanon is a little bit of a different market. Lebanon is more like Perry County, more like Cumberland County, more like Franklin and Adams County. Lebanon is a little bit more of a rural county. Lebanon is more of a bedroom community to Lancaster and Harrisburg. So the ratios are the same here. We're tracking Lebanon County because it's a much smaller county and it's easier to chew on what the numbers are. But what we've seen in Lebanon County, for our purposes here, has been similar to what we've seen in all the other counties. But if you were just to ask the blanket vanilla statement, Judah, do you think Lebanon is like Lancaster? No. Do I think York is like Lancaster? Yeah, more than anybody in Lancaster wants to admit. Do I think Harrisburg is like Lancaster? Yeah, more than anybody in Harrisburg wants to admit. But those are very similar markets. Lebanon is a different market. Does that make sense?
So if we look at Central PA just in general as a region of the state, of the country, whatever, the area is very similar in that there is a lot of blue collar employment. There is a lot of stable employers that are, Fortune 500 type companies that, there might be some fluctuation in employment, but it's not huge. It's not as if they're shutting down the corporate headquarters and going to Mexico or some other state. So, I look at this and look at the trends and things like that, just as an illustration. And again, Judah said this, I'm using Lebanon County because of the size. That's it. All right. So now what's our next stage? What's coming next? Early downturn. Right. We're looking at the peak of the market. And the truth is, we're not going to be able to see the peak until it's passed, right? You'll start seeing houses stay on the market longer. You'll start seeing prices begin to drop slowly and incrementally. Rent growth is going to flatten out. Returns are not going to be as good, certainly with flips. And you'll start seeing cap rates finally start ticking up. That's been frustration over the years.
Can I hold on? Let me just interrupt you to say something here. One of my favorite things about early downturn and also early upturn, you don't see it during early upturn because it's much easier to be a pessimist than it is an optimist. But right now, every month, people are saying this is only lasting another month. This is only lasting another month. For about the last year, I can tell you 5 or 6 people who I have heard every month have said it's only lasting another month or two. Yep. And as soon as we actually see early downturn, they're going to say, "See, I told you."
Yeah. Listen, I'm guilty of that. I'm totally guilty of that. I would have anticipated the market. I did predict the market crashing by now. So anyway, one big factor here to consider as you think about what's next, as you're planning on once things start changing, what do I do next? A big one here is credit begins to tighten. And Judah brought this to my attention before we jumped on the air. If you are in a position that you have rental properties that you haven't refied yet, or you're
refinance them and pull all the cash out.
Yeah, pull all the cash out, or at least refi to a lower rate and save yourself $50, $100, couple $100 a month.
Especially if they're B or C, especially if they're A or B quality rentals, and they're A or B quality rentals. Especially if they're 3-unit or 4-unit properties, where even if you get a little bit of vacancy, you're still going to be able to make that mortgage payment. Pull that cash and get it ready to be redeployed, or start redeploying it, or have that cash separated from the equity so that you can make mortgage payments during an economic downturn or some difficulty. I'm not saying go crazy and over leverage the properties or anything like that. 70-75% loan to value loans, so that if there is a 20 or 30% pullback in price and you absolutely are forced to liquidate something, you can still liquidate something if you have to. But if you have that cash separated from the equity, you should be in pretty good shape. Here's what I would tell people, and I would encourage people. We are in a late stable market. Mm-hmm. Act like we are in a late stable market. Don't act like we are in a recovering market. Don't act like we are in early downturn. act like we are in a late stable market for as long as we are in a late stable market. And then as soon as we're no longer in a late stable market, pivot and do something different. Do the different thing once it's time to do the different thing. But you can't do something too soon, because then you're just going to, if you think that we're in an early downturn and you act like we're in an early downturn, you're going to see all kinds of people doing deals that, and you're going to miss up all kinds of opportunities. If you think we're in a recovering market, then what you're going to do is you are going to be making mistakes and opening yourself up to a whole lot of liability and a whole lot more risk.
Yeah.
So do the deals based on what market we're in, not what market we were or what market we're heading for. Does that make sense, Josh?
Yeah, that makes a lot of sense. And you know what? It reminds me that I screwed up these slides. The last two, there should be two slides here. So let's talk about this. What does that mean? How do you act like we're in a late stage, uptick in the market, right? That means don't get into any huge rehab projects. That doesn't mean don't rehab a property, but don't get into a project that's going to take you 6 months to remodel. And knowing that when you go in, the after repair value today is 400,000, but if there's a decline in values in 6 months, where's that put you? Unless you're in a big discount, right?
Yeah, I was going to say, make sure that if you're doing 6-month rehabs, that you can afford a 10% pullback in the market. I would also say this, don't anticipate appreciation during early recovery. You almost have to, and it feels risky, but you almost have to do deals on a tight margin, knowing that you're going to be picking up value during the rehab and marketing time, just by natural course of appreciation.
Yep.
You've got to really watch that during early downturn.
Yeah. All right. So how do you invest when we get to this early downturn? Right. First thing, Judah loves this exit strategy, subject to.
Yep.
You've got historically low interest rates. You got people that bought at market value at the top that have to sell. Well, look, you're not going to be able to buy that thing for market value. You're not, unless the terms are right.
Right.
And if they're willing to, sign over the deed and let you pay the mortgage, that's a great situation.
Your terms and my price, or my terms and your price.
That's right.
So if somebody needs to sell that $150,000 property for $150,000 and they owe 140 on it, most people are going to be offering them 135, 140, and they're not going to have the money to make that deal work. I'll buy it from them all day long by taking over the payments on the existing mortgage. By the way, I just want to correct. Subject to is an acquisition strategy, not an exit strategy.
I'm sorry.
Minor difference. Minor.
All right. So that's the first thing. Number two, short sales. This is what's going to come up 100%. As the market is declining, banks are going to have to take a haircut on what they're willing to accept, or they're going to be overrun with, inventory that's not selling. So hooking up with a really good short sale expert is a good way to go. And you know what? That just reminds me, that's who we can bring on as our guest if he's going to be around. Yeah, we've got a friend who is, he's actually doing a short sale for me right now. That is, I've been super impressed with his process and his team. So short sales are going to be a big one. And then number three, if you're buying cash and you've got a seller with tons of equity, you got to buy at a deep discount. Right. You got to anticipate selling at 90% of after repair value, at today's value. And, it's just something that you got to work into your numbers. Again, though, this is also a situation that if you're doing a buy and hold, you got to anticipate an appraisal coming in, within that 90%.
Yeah, the Burr method is more difficult during a downturn.
Yep.
Because you're going to be ending up leaving $15,000 or $5,000, $10,000, $15,000 in properties. And I remember getting really good at the math and showing people how even though you're leaving money in this property, it's still a better rate of return than if that money was tied up anyplace else for you in the
That's
stock
right.
market or anything like that. So there's a lot of interesting things that happen during during a downturn. The other thing you have to be careful about during a downturn is just be prepared to talk to a whole bunch more people, because when you're buying from motivated sellers in a downturn, they might not be ready to admit that their $150,000 property is actually not. They might. There's a lot of people who say, "Oh, well, my house is worth 150. I know an investor is going to want to buy it, and so maybe they'll buy it for me for like 100 because it needs some work or something like that." But a lot of people won't understand is that $150,000 house that needs work is now actually only worth 140 or 135, and therefore an investor is going to be offering me 80 or 75. And so it becomes, to find the motivated sellers who are willing to take the lowball offers, you have to talk to a whole lot more people.
Yeah, but what
or
goes
do more marketing.
Well, and what goes with that, Judah, is that a whole lot more people are going to be interested in talking to you because houses aren't flying off the market in 10 minutes.
Yes, 100%. Yeah.
So
it's easy, it can be easier to find the people. It can be easier to get your numbers. Also, the other great thing is, there's 400 listings right now in Lancaster County for 1,500 realtors. During an early downturn, there's going to be a whole lot less realtors. There's going to be a whole lot less wholesalers. There's going to be a whole lot less people marketing. Josh right now is doing marketing because he's a hard money lender and he's an investor himself. Well, if he does a mailer or he does a text blast, those motivated sellers might be getting a mailer from 5 or 6 other investors this week. You know what I mean?
Right.
2 years from now, when he does that mailer, they'll still get 5 or 6 other investors mailing them, but it'll be 5 or 6 cumulative over a month instead of every week getting mailers from 5 or 6 different people. So there's a whole lot less competition. So it's just different. It's not good. It's not bad. It's just different. That's what you have to remember.
Yeah. And if you're not prepared for it and you're not willing to change what you're doing right now, I mean, you're going to end up upside down. And in fact, in 2010, I stopped wholesaling because I was getting a ton of leads and people were willing to hand me their house, but they were so upside down, they'd stripped all the equity out of their property that I couldn't offer them what they owed. And it was a very common mantra that I saw. And it was like, look, my margins went from 17,000 to 2,500. And now I got to do 10 deals a month just to break even. That's not a very good scenario.
Right.
So
all right. So we got to wrap up the show. But Steve asked a good question here at the end that we are going to cover tomorrow. Do buyers become more selective as well? And this goes in with the market cycle. We talked about 6 different cycles of a market. If we were to break down the market into just 2 cycles, it would be buyer's market and seller's market. And we can talk about we can touch base on that a little bit tomorrow as we continue talking about market cycles. So tune in tomorrow, dear listeners, for what happens with those. And arbitrage and subject to, man, Steve is talking about all kinds of things.
Steve, I'm going to have to send you a t-shirt for all your comments.
Right.
All right, guys, thanks for joining us today. I'm a hard money lender with Hard Money Bankers. Judah is a real estate agent with Slate House Group. If you guys are looking for funding on your next deal, or you're looking to sell a property or buy a property, reach out to us. Our numbers and contact information are at the bumper at the end of the show. We really appreciate you tuning in. We'll be back here tomorrow at noon. Till then, you guys have a great day.
See you, everybody.